Before you buy another coin, before you jump into another so-called project, before you follow another influencer, you must understand one thing. Most people don't lose money in crypto because the markets are bad. They lose because they make the wrong moves at the wrong time. So today, I'm going to show you the 7 crypto mistakes that 95% of people make, and how to completely avoid them before it's too late. Stay till the end, because mistake number 7 is the silent killer that destroys entire portfolios without you even noticing. Let's begin. The first and most common mistake is buying coins without doing your own research. Because a friend said it will moon, an influencer tweeted about it, or they saw a pump chart on TikTok. But here's the truth, if you don't know what you're buying, you're gambling, not investing. DYOR, or do your own research, means understanding the fundamentals of a project. Why does this token exist? What problem does it solve? Who is the team behind it? Even in hype-driven markets, coins with no real utility or a solid plan are the first to collapse. He threw his money in without a second thought. A few days later, the developers rugged the liquidity, and the coin's value went to zero. Ali lost everything because he followed the crowd, instead of doing a simple 10-minute check. You can avoid this by reading the project's white paper, or at least a summary of it. Check its tokenomics, how many coins are there, and how are they distributed. Verify the team behind the project. Look at their roadmap, trading volume, and liquidity. These simple steps can save you from major losses. By the way, mistake number 6 is one that even experienced investors fall for, so don't miss it. You see a big green candle shooting up, and you panic buy, thinking you'll miss the ride to the moon. But here's the secret, huge sudden pumps are often designed to attract late buyers just like you. Whales, the big players, use that rush of buying activity to dump their bags, leaving you holding the worthless coins. Buying a big green candle is almost always a losing move. Those who bought at the top got wrecked. The key is to stop reacting emotionally. Set your entry zones beforehand and wait for the price to pull back to those levels. Which brings us to mistake number 3, having no risk management. Crypto itself isn't dangerous, your lack of risk control is. Most beginners make the same fatal errors. They put all their money into one single coin, hoping it's the one. They invest money they can't afford to lose, sometimes using funds meant for bills or emergencies. This is a recipe for disaster. When you're overinvested, every price dip feels like the end of the world, leading to panic, selling, and terrible decisions. The solution is simple but crucial. First, never ever invest more than you can comfortably afford to lose. Your crypto portfolio should not impact your daily life. Second, keep your emergency funds completely separate. Third, if you're an active trader, learn to use stop losses to protect your capital. And for the love of all that is good, avoid leverage completely as a beginner. Leverage amplifies both gains and losses, and it will wipe you out faster than you can blink. Just think of the people who put their life savings into Luna at $80, only to watch it collapse to less than a penny. Proper risk management would have saved them from that catastrophe. Next up, mistake number 4, overtrading. Many new traders have this misconception that more trades equal more profit. The reality is the complete opposite. More trades often mean more trading fees and, more importantly, more mistakes. The crypto market is volatile and designed to take money from impatient people. Overtrading, especially without a solid plan, just drains your portfolio through fees and bad, emotional decisions. Maybe you lost a trade and immediately jump into another one to win it back. That's called revenge trading, and it's a surefire way to lose even more. If you're not an experienced trader, stop trying to catch every small move. Avoid short time frames and focus on a long-term holding strategy. It's less stressful and, for most people, far more profitable. Mistake number 5 is a huge one. Ignoring security. Let me be clear, crypto protocols rarely get hacked. People get hacked. Your security is your responsibility. Scammers are everywhere, and they are relentlessly creative. They use phishing scams with fake websites that look identical to the real ones. They send you DMs on Telegram and Discord from bots promising guaranteed profits. You might get an email from a fake MetaMask support asking for your details, or see a fake airdrop that asks you to connect your wallet. The number 1 rule is to never ever share your seed phrase with anyone, for any reason. Your seed phrase is the master key to all your crypto. Use a hardware wallet for long-term storage. Enable 2-factor authentication on all your exchange accounts, and only use official websites. The FBI reports that billions of dollars are lost every year to simple phishing attacks that could have been easily avoided. Don't become another statistic. But the final mistake, the one you're about to hear, is the one that silently destroys most beginners. And it's mistake number 7, not having a strategy. This is the root of all the other problems. Most beginners are just investing randomly. They have no plan, no entry or exit targets, no portfolio structure, and no consistent investment rhythm.